right, everyone. Good afternoon once again. So welcome to the SBR Grand Revision Day 1 for our September 2025 attempt. Now, in today's session, we're going to cover our most recent past paper, which was a March-June paper. So normally when they release a paper, they are mostly releasing a mix of papers. So you won't see an exact replica of June 2025. You'll see elements of March and you will see elements of June. So we have a March-June 2025 paper and we're going to crack that today. Our focus would be question 1 today, which is the group's pre-populated question. And then we're also going to cover question 2, which is Byfloat, which is again on the ethics and then amalgamation of standards. And tomorrow, which is a day 2, we are going to cover question number 3 and 4. Okay. Important session tomorrow as well, because you will have some niche areas that are getting tested, which is modification of revenue, modification of lease contracts. So before starting tomorrow's session, ideally, I would touch base upon modification of revenue and modification of leases. Modification of revenue is already there in your pre-recorded sessions, guys, but modification of lease is something that I'll touch base tomorrow prior to the session, and then we'll have our session. Okay. So we'll begin with the groups pre-populated. I would want you all, I'll give you all 2 minutes. I would want you all to go to the platform, the past practice paper platform. If you all want, I can share the link in the chat box. Go there and launch this March-June 2025 paper for yourself. Okay. So I'll just pause my screen and try to make a login. By that time, you all will also parallelly do the same. Okay, great. So what I feel like, it's going to be a little bit different for you and me, because what will happen is, okay, I'm going to start sharing my screen again. I've logged in. So I'm going to start sharing my screen. Once you're on the screen, right, you have an option of browse available exams. So click browse available exams. Now over there, of course, you're going to go to your SBR. And inside SBR, you would be having a March-June 2025 paper. Yes, I do have it. I do have it. And you will click assign. You will click assign. Okay. You will click assign. If there is any difficulty, put in the chat box. If there's any difficulty, put in the chat box. For me, because I've already assigned it to myself, it's in my view of assignments category. Once you assign it, how do you view it? You have to go to your view of assignments category. Okay. And then I have my assignments here. So I have to, because it's kind of midway for me, I have to click resume, right? For you, you would probably begin the exam. You would probably begin the exam. And you would have all these screens, right? That is what you're going to see on the actual exam day. And then you have to click next, next, next. You have to scan through all the screens, like quickly, like just put your scroll bar down, navigate it, and then click next, next, next. Okay. I didn't have to do it because this was kind of already started, right? So I didn't have to do this. So I would want you all to come to the question first, pre-populated, which is Egap Company. Egap Company. Okay. I'm giving you all a minute more. Please come to this. Okay. I believe everybody's come there already, right? Okay, great. So without wasting much time, we'll begin with the question. So like I said, you all know, like this is the fixed pattern, how you have to expect your SBR paper. That question 1 is around groups, right? Now, the way the groups have changed from September is not a lot of has changed, but a little bit of expectation has changed. Meaning what? So because IFRS 18 has been introduced, which is around the new presentation of PNL, Now, when you develop your answers, especially in question number 1, even in other areas, but especially in question number 1, you'll have to write a lot of impacts, right? For sure. So whenever you're writing impacts in question number 1, that, okay, this item is going to go and sit in my profit and loss, and this is going to go and sit in my balance sheet under assets, all that is good. But when you're mentioning profit and loss, you have to mention which area of profit and loss, whether it's operating, whether it's financing, whether it's investing activities, whether it's from profit from discontinued operations, whether it's in the tax section of the PNL. So you have to be very specific. This is the new ask in your paper from September onwards. Okay. So you will see now, when I'm going to crack this question, you will see how the change is, impacting, how the change is impacting. Okay. So I'll read the background first. We'll read the requirements and then we'll cater them one by one. Okay. So, okay, Egap Company is the parent of a group. Any problem in visibility of my screen, my voice, or my video, you will let me know, okay? Otherwise, I'll continue assuming everything is perfect. Okay, all those who are facing error right now might try to, access the paper later, but for now, I'm beginning the session and you can see the question on the screen, right? So for now, to follow shouldn't be a problem, okay? So Egap company is the parent company of a group. It prepares financial statements using IFRS accounting statements. The financial year end is the 31st December 20x7. Great, calendar year. The following exhibits available on the left-hand side of the screen provide information relevant to the question. The first one, acquisition, provides information about the acquisition of shares in Bryn company. Second, defined benefit plan, provides details on an amendment to EGAP's defined benefit plan. Third, draft consolidated statement of financial position. The draft consolidated statement of financial position SOFP for the EGAP group as of 31st December 20x7. So you know that you have information around acquisition, and mostly because if it's acquisition, it will be related to goodwill calculation. Then you have a defined benefit plan, and you all know that defined benefit plan by now. It's a little hot favorite. It's been coming, a lot many times. So, and it's not that it's difficult also. So it's good to have grip on this topic, okay, on your employee benefits. Okay, now this information should be used to answer the question requirements within your chosen response options. Okay. Now let's move to let's move to the requirements of this. I don't know why do I see this weird error. Okay, if it keeps bothering me, I'll have to pull this on the Excel. Never mind. Okay, so using exhibit 1, explain with calculations. So you know that identifying what is the ask of the question is very important. Is it calculations, or is it calculations with explanation, or is it just explanation? So right now they're asking explain with calculations. In accordance with IFRS accounting standards, how to correct the accounting treatment of the investments in Bryn in the consolidated financials for the year ended 31st December 20x7. How to correct what? The investments in Bryn. So there is some mistake. They're already telling you there are some mistakes for the investment. You have to pass the correcting entries. You have to pass the correcting treatment and explain it. Your answer should include a revised calculation of the goodwill arising on the acquisition of Bryn company. So first is correcting the investment and also doing a calculation for goodwill, okay, arising on the acquisition of Bryn, and this is worth a 10 marks. So of course you'll have to do calculations, you'll have to do explanation both. Now B is using exhibit 2, explain with calculations and in accordance with IS 19 employee benefits. So explain, again calculations, what is it? IS 19 employee benefits. How to account for the defined benefit plan. It's not defined contribution, it's a defined benefit plan in the CFS for the year ended 31st December 20x7. Okay, so we'll deal with it later. It's another 8 mark. I would also want to read the final requirement because I would want to understand if there is any link of exhibit 1 with the final requirement. If yes, I will do it parallelly. This is the approach, and this is the best approach. My students would know it that when we're doing requirement A, we will always do the pre-populated parallelly if we can. Like if in requirement A it is very clear that what is the mistake that's done, then we can very clearly put a correction in the pre-populated. Okay, but sometimes after reading requirement A, you don't know what is wrong, what is wrongly been done. Right, in the scenario, what is wrongly been done. So how do you make a correction? Then you can't make a correction. You have to hold yourself back. You have to just do calculations. You have to just do explanation. Only when you come to your final requirement, they'll give clarity. Okay, so and so item was wrong. Then you reverse the so and so item and pass a correcting journal entry. When I say by passing a correcting journal entry, the sole purpose is not passing correcting journal entry. That's one step. When you have to pass adjustments in pre-populated, if you do a journal entry and then do a pre-populated, things are much, much more easier. Correct? Now, the final requirement is using exhibits 1 and 2. So of course, requirement A is connected with the final one. Using exhibits 1 and 2 and your previous answers, adjust the pre-populated spreadsheet response option to correct the draft consolidated statement of financial position as of 31st December 20x7. So clearly they're connected. And when I'm reading exhibit 1, let's see if I have enough information to make the final corrections. And one more thing, this is worth a 10 mark and the pre-populated corrections are worth 12 marks. Okay. So there is a good chance that while you're cracking this 10 marks, at that time itself, parallelly, you will be able to grab, let's say, 6 marks out of 12 or 8 marks out of 12 parallelly, immediately. Okay. So we'll see how. So I'm going to come to the exhibit 1 at this point of time. Just zoom it a little bit more. Right. Okay. So it says on 1st January 20x7, my year end was 31st December 20x7. They're saying 1st January 20x7. Egap paid 4.3 million to acquire 25% of the $5 million one equity shares of Bryn. Now, when they're saying 25% of 5 million, can you all tell me what type of investment is this? Is this ordinary investment in shares? Like, is it not creating any relationship? So Salim, Neo, Mamu, and Priscilla, Asra, and then there are others who are saying that no, there is a relationship. If they're saying 25%, and if there is no information, to counter this relationship of associate, then this would be an associate relationship. This would be an associate relationship. So if it's 20% or above that, but less than 50%, then it's going to form an associate relationship, right? So in this case, if I have no information which negates that, okay, they'll not get significant influence. So associate meaning you'll have significant influence. And how can you have significant influence? If you have that many votes in the opposite company. Let's say if 25% of the 100% votes are literally with you, then that actually means a significant influence. That actually means a significant influence. You'll be able to influence the decision, right? But you will not be able to control the decision because let's say 75% of the votes are not in line with what you think. So you can't control the decision, but you have a very good weightage. So let's say you 25% and someone else 30% together. Of course, there is influence then, right? So yes. So this shareholding enabled Egap to exercise significant influence. So there's no information up until now also which negates the significant influence. Rather, we have additional information which is saying that yes, significant influence is present, okay, over Bryn's financials and operating policies. Now, Egap recorded this investment in Bryn at cost within financial assets in the draft consolidated statement of financial position, and no further entries have been recognized. In the consolidated statement of financial position, they have recorded this just as a financial asset. Just as a financial asset in the consolidated financial statement. And they're saying no further entries have been recorded, okay? Just as a financial investment and also at cost. The other main issue that they're bringing to our notice is that they have, that they have put this at cost. Okay. Now, I want you all to think through this and tell me that was this correct? Was this correct? No. What should have they done? What kind of accounting is required for an associate? What kind of accounting is required for an associate? Equity accounting. So for me, it's important that I identify that this 4.3 is wrongly recorded as an investment in shares. I have to reverse that and do a debit investment in associates. So this is the first correction I'll do. If y'all want, I'll take y'all back to the original requirement. What did the original requirement say? I have this on the other screen. I'll have to delete it because it's constantly going to stay otherwise, right? So anyway, we'll navigate from here itself. So if you may remember the original ask, you do not hesitate in going back to the requirements whenever required, because if a requirement is not clear, you can't cater it, okay? So using Exhibit 1, explain with calculations and in accordance with IFRS how to correct accounting treatment of investments in Bryn. This is one of the asks, okay? This is one of the asks. Okay, your calculation should include goodwill, that's another ask, but this is one of the asks that how do you correct it? So let me start already correcting it. I'm not going to wait, maybe. I'm not going to wait. I'll already start correcting, okay? So I know 4.3 is recorded as investment in shares. I would want to also probably have a look at my pre-populated. How does my pre-populated look like? So if you see, your pre-populated has investment in associates and has financial assets as well. So your right now it's recorded inside in here, and I want to remove it and put it in the associates. So I can already do that. Okay, I can already do that. So I'm going to take my word processor. I'm going to take my word processor and I'm going to write this over there. Okay. So this is my, okay. So investment in Bryn company is up to 25%. And it is also mentioned that, so I would, yeah, Egap company has significant influence on Bryn company from 1st January 20x7. Therefore, this investment was an associate and should have been equity accounted. Therefore, a correction is required. Investments from shares will be reversed and will be added in investment in associate in balance sheet. If y'all want, for your comfort, y'all can immediately do a journal entry, but not necessary. This is not necessary. Investment in associate, credit, and you can have over here your investment in shares. This is your correcting journal entry, okay? And how much was this? This was 4.1 million. Now, so this involves calculation. So I did calculation. This involves explanation. I did the explanation then and there. Okay, because these were not hardcore calculations. I did not start with spreadsheet. If these were hardcore intense calculations, I would start with spreadsheet and then come to the explanation, maybe like towards the end of exhibit 1, once I've solved it. But right now, the calculation is very much ready-made. I just have to explain what I'm doing, right? So I did start with Word. Otherwise, normally if you see, there are intense calculations involved right at the beginning and we start with spreadsheet, okay? No problem. This immediately we are going to go and do the 4.1 correction in our spreadsheet. So come to your spreadsheet and you can write over your associates. So first step that you have done is reclassification. First thing that you have done is a reclassification, okay? So less the 4.1 from financial assets, less. So I don't see a negative sign. Yeah, negative. And then add a 4.1. Yeah, so Mohammed Yusuf, that's correct. Credit is financial assets. What have I done? Have I not done that? Yeah, financial assets, investment in shares, nomenclature being different, but I'm trying to say same thing, right? The financial assets here, okay? Your GL name could have been anything, right? But balance sheet line item is financial assets. If you all want, I can put it in this manner as well. That's okay. Okay, is everyone comfortable with this or anyone has an issue? I just want to confirm if it's 4.1 million only or not. Sorry, so it's 4.3 million, not 4.1 million, it's 4.3 million, right? So just make this correction. It's 4.3 million. Make this correction. Yeah, so okay, Nurdan is asking me that why did we not credit from financial assets? So is it clear? I changed. It's just a nomenclature of GL, right? I mean, when I write investment in shares, it was also in GL that I was talking about. Financial assets is a line item in my balance sheet, and the GLs that I create in the system could have different nomenclatures, right? They all could be sitting in financial assets. Okay. How do you maximize your spreadsheet? I think you have to just like stretch it from the bottom ideally. There should have been like a at the corner something to stretch it. Yeah. So can you see it's at the top left? So you can stretch it from the top left like this. Resizing you can do from the top left. Normally it's at the bottom right, but this is at the top left. Okay. So I hope this is clear now. So yeah, all those who pointed out 4.3, that's absolutely correct. It's 4.3. I just happened to read it as 4.1. That's okay. Now, moving to the next bit, I'm going to continue to read now. So understand what I did. Okay. So out of the first paragraph, I identified what is the numerical impact. I did the explanation around it. So probably I got like my let's say 3 mark, like 2 marks at least, let's say. And also in my pre-populated, I went and I did the adjustment. So on the lower side, whatever I've done right now has at least, helped me fetch 4 marks immediately. 2 from the final requirement and 2 from the current requirement on the lower side, I'm saying. Okay. So this is the, I would say, power of doing it at the same time, all the impacts and whatever is required around it. Okay. Now, on 31st December 20x7, Egap acquired a further 45% of Bryan's equity shares and gained control. Can you all tell me when I read this line? So from 25%, you have now further acquired 45%, and which means you have now in total 70%. What is the situation called? What is the situation called? So this is a situation of no control to control. It's a step acquisition. Absolutely right. New, Salim, Taha, Michelle, Mitchell, everybody absolutely correct. Yeah. That from a no control to control situation, this was no control, right? This up until this point, it was no control. But after that, we have been to a control situation. Okay. It's called a step acquisition situation. So yes, that's correct. Now, consideration comprised of 15.1 million and 1 million of EGAP's $1 equity shares, which had a fair value of 3.2 each. Now, I can go about this in two manners, in two ways. Now, when I'm reading that step acquisition has happened and control has come, and I remember the requirement of the examiner was to continue to correct the investment along with calculation of goodwill. When I read the second line, I know I have enough information that's starting to come to develop my answers regarding goodwill. It's talking about the purchase consideration, right? How much did I pay? So, one thing is I continue to read, or the other thing is that at least from this information, I start developing my goodwill calculation. Okay, it's up to you. I will always say that go very step by step. So, if you have something and the ask is very clear. You have clarity on the requirement that goodwill was asked, and this information is required for goodwill. Start putting it in place. Start putting it in place. Okay, that's the best way to go about it. So I'm going to go to my spreadsheet. And I'm going to have in my workings, I'm going to write over here working one, let's say. And this is what? This is my goodwill calculation. Okay. So purchase consideration. Again, you could have few different nomenclatures here, which is fine. Cash and share exchange, right? So in two ways, you have ended up getting that 45%. If you realize, in two ways, you have ended up getting that 45% of shares. How? One is cash and the other is 1 million of equity shares. So parent himself is giving 1 million of his own equity shares to acquire this 45%. Okay. Now, 5.1 million is the cash element. Equity shares, they said, had a fair value of 3.2 each. So let's start putting this also. So 15.1 for the cash. And for share exchange, they said 3.2. So they said 1 million equity shares into 3.2 if is the fair value, then this is how I'm going to have my answer. Okay. Now, without wasting much time, I'll read further. So like you can see, I already grabbed mark. Like maybe I'm getting a 1 mark there or a 2 mark there, but it started to grab them. On 31st December 20x7, this is my year end, right? Bryan's quoted share price was 5.7. Whose quoted share price? Bryan's. The subsidiary that we are acquiring is 5.7. The fair value of Bryan's identifiable net assets on 31st December 20x7 was 14 million, which was the same as the carrying amount in the individual financial statements. Y'all know when I have to do a goodwill calculation, I need net assets because how do I get goodwill? Whatever I'm paying, less whatever I'm paying to acquire, less the net worth. That's your basics, right? That's your basics. I know there are other elements, but in essence, what are you doing? You're checking whatever extra you're paying above the net worth. So 14 million is the net worth. So I have to deduct that. Now I had one more information that came above was Bryan's quoted share price is 5.7. Can you all think and tell me where or how could I use this information, if at all I could use this information? How could I use it? How could I use it? Subsidiaries share price. Where in my goodwill calculation can I use it? Absolutely correct, Zad. So he said NCI, non-controlling interest. So non-controlling, so if they mention that the NCI is measured using fair value method, then I'll use this 5.7. Okay. So till now I'm going to hold myself because they did not mention NCI's fair value. But I'll punch this 14 million. I'll immediately punch this 14 million. Okay. So I'll go to my spreadsheet and I'll do purchase consideration, add NCI, and because this is a step acquisition, you will have existing shares as well, right? So fair value of existing shares. Sorry. So I've put up the formula. I've put up the entire formula, okay? Now I have to just keep filling in the information. NCI, fair value of existing shares is still missing, okay? Yeah, previously held shares is fair value of existing shares. Absolutely correct. Now, so I'm here now. In the year ended 31st December 20x7, Bryan reported a profit of 2 million and no other comprehensive income. So subsidiary reported a profit of 2 million. Now, how could I use this information? How could I use this information? See, you had investments in shares, which was your financial assets recorded, and they said they were recording it at cost. You removed it from there and you've put it as investment in associate. And how do you account for investment in associate? As equity accounting. So this is that profit subsidiary has made, and you'll have to increase investment in associate by subsidiary by share in its profits, right? By share in its profits. So I'll have to do this. Whatever my investment is, I'll have to increase it. Okay, I'll have to increase it. Sorry. So I'm going to do this now. Investment in Bryn company will be recorded using, okay, we have already mentioned that we will be record using equity accounting. And you mentioned as per IAS 28 investment in associates. Or you can just write IAS 28 also. You don't have to write the whole thing also. Okay, that's fine. Now, basis equity accounting, investment in associate will keep increasing by its share in profits. Profit for the year is 2 million. Therefore, investments in associates will increase by 25% of 2 million. I mean, for me, I don't have to do a calculation on calculator. 25% of 2 million is very straightforward, right? That it's a 0.5 million. And the other leg is profit from associate recorded in. So earlier I could have very easily written it as recorded in profit and loss statement. This would have been fine. And what the complete mark that is there. But right now I'm saying no, this is not going to be cool. It won't go well with the checker. He's not expecting just profit and loss. Can you all think and tell me what is more expected over here? I can't just write profit and loss. I'll have to write something else as well. What else do I write? Okay, that's right, Asra. That's right. That's right. Others? Absolutely correct, Priscilla. Yes. So, because of IFRS 18, now I can't write just profit and loss statement. I can't just write profit and loss statement. I'll have to write recorded in investing activities in the profit and loss statement. Okay, so I hope this is clear with everyone that how the answers are now changing also. So your correcting entry would be, like I said, this is fine if you don't do it. Like you don't have to do a correcting journal entry, but it always gives a lot of clarity and makes things a lot more easier. So because I don't have my P&L, I have to see in the balance sheet where this is going. So in my balance sheet, can you all tell me which line will this impact? Profit from associate in the balance sheet, where will it go and sit? In P&L, you all told me investing activities, which is fine, but I don't have a P&L, pro forma right now. They did not give me a P&L. So profit from associate in the balance sheet as a correction, where will it go and sit? And the retained earnings, absolutely correct. This is going to go and sit in my retained earnings. So again, I'm not going to wait for anyone. I'll go and make the correction. Okay. So 0.5 in my investment in associate, I'll add. And I will also do this in my retained earnings. Absolutely correct. Okay. Now coming back to the question. In the draft consolidated statements for the year ended 31st December 20x7, Bryn was treated as a subsidiary and accounted for using the acquisition method. So they did treat him as a subsidiary. That's there. They did treat him as a subsidiary and accounted for using acquisition method. So they did the goodwill acquisition as well. In the draft consolidated SOFP, the non-controlling interest was measured at acquisition at its proportionate share of the fair value of Bryan's identifiable net assets. So currently, if you can see at the bottom also, there is a goodwill calculation that they have done. But the NCI measurement is a proportionate of net assets method. Okay. However, the policy of Egap Group is to measure the NCI at its fair value. Remember, I told you all something over here that this quoted price of subsidiary, I can use this information for NCI if NCI is at fair value. If NCI is at fair value. And here I got to know that their policy is fair value, but they ended up using proportionate share. They ended up using proportionate share in a calculation that they performed. So their calculation is of errors, is full of errors, and we are doing a recalculation of goodwill, which is a corrected version. Okay. So we can see over here what all they have done. Okay, we can do a comparison also. What all they have done. They have done a cost of 45% holding paid at 31st December, which I've written as purchase consideration, right? So this they have written it as 15.1 million. So this is correct. If you may see, that's what we have also got. We've got a 15.1 million. Sorry. So I think it got some, I had taken it, the cash figure, but I think while doing a copy paste at the bottom, some issue came. The cash figure was how much, if I may see? Yeah, comprised of 15.1, right? So yeah, so this part is fine. This they have done it correctly. Okay, when they tell me that they took it as 15.1, I'm happy. They've done it right. They say for NCI, they've just done a 14 million of 30%, which was wrong, right? They had to take the fair value. So I'll reassess NCI. They did a fair value of identifiable net assets at acquisition of 14 million negative. This is fine. This is correct. This is correct. Can you see? Even we have done this. This is fine. And then they have a goodwill of 5.3. So as a result, if they have not taken the NCI correctly, and if there are so many other elements which they did not take, then of course they're not going to get a correct goodwill, right? So that's why doing a recalculation. Now, what all have they missed? What all they have missed? They've completely missed the fair value of existing investment. They've completely missed that. right? They've completely missed that. So we'll have to account for it. So basically, they have missed fair value of that existing investment. One more element they have missed. Can you all identify? I'm not talking about the wrong. NCI is wrong. That's fine. I'm talking about right now, which is completely missed. What is completely missed? No share consideration. So Asra is correct. There is no share consideration at all that's recorded, right? So that's also one missing element. Now, what we could do is, because I'm not doing on my Excel, I can't take a screenshot, but that's fine. We'll keep navigating quickly. Okay. So what are we going to do now is, we will, because I know NCI is at fair value, I'll now record at least NCI valuation, right? So NCI is going to be how much now? 30%. 30% of how much? 30% of 5 million. 30% of 5 million. Okay. Into how much was the share price? It was 5.7. Okay, wait. There are other things also that I want to take care of. Now, fair value of existing shares. So, fair value of existing shares has been missed also. Now, can you all think and tell me, for the fair value of existing shares, what value do I pick? What value do I pick? So, I have done one thing at least. That investment I have taken at cost and I have added its share profit. So as a result, if you may see, 4.3 million and 0.5 million. So investment in associate is standing at 4.8 million. Investment in associate, if I club these two, is standing at 4.8 million. Now, what figure should I pick from the scenario to find the fair value of that existing investment? Can you all think and tell me? Because when I'm doing this formula, fair value of existing shares, how much did I have as existing shares? I had 1 million, correct? I had 1 million. 1 million into what, guys? 1 million into what? Market price, which from the question you can see that I just now took for NCI also 5.7. Same figure, okay? Same figure I'm going to use here, okay? So now it looks pretty much complete. So I'll do a sum and check how much goodwill am I getting. So I'm getting a 18.6 worth of goodwill, okay? Cash, share exchange, NCI into 30% and a net worth of 14 million. 5.7, let me just make sure. 1 second. Yeah, that's what I'm just myself just doing a cross check quickly. Yeah, because I think this thing is on rounding off. That's why it's rounding it off to 1, but it's actually 1.25. So I'm going to show what I'm trying to say over here is that 1 million into 5.7 I can't do, because what happens is you have 5 million shares in subsidiary, and when you take 25% of 5 million, they're not 1 million. So it gave me a rounded off answer actually. That's why I took it as 1 million. It will give me 1.25. It will give me 1.25 million, okay? I don't want to this extent of rounding off actually. Yeah, so I've just I've just clicked here and I've clicked on this 0.00 to remove the rounding off effect, okay? The problem is when I did a quick calculation, 25% of 5, it gave me a 1 million rounded off answer. But then if you take the rounded off answer and if you do a 1 million into 5.7, you won't get a correct answer, right? So you don't want a rounded off answer. Keep your answers up to at least 2 decimal places. And when you do that, you have 1.25 million. 1.25 million into 5.7, when you do, you are getting a 7.1 as the fair value. So I hope that doubt is understood by everyone now. Salim, did you understand this now? Mohammed Yusuf, Salim. Okay, great. Okay, fine. So now what we have as a goodwill is a 19.98 million. Okay, what we have as a goodwill is a 19.98 million. Now, I would want to clearly compare this with what they have, okay? What they have. And can you see over here? what they have done is they disregarded the 7.1 completely. They never took that. Okay. If they never took that in goodwill calculation, it means that, so one thing is, yeah, they did not take it in goodwill calculation, and they have not even recorded for the share exchange, the share capital, the share premium. So what I will do is, now I will form my correcting journal entries. I'll form my correcting journal entries where I'll go and I'll adjust for all this in my pre-populated. I'll go and I'll adjust for all this in my pre-populated. Okay. So the other thing, when I'm going to start with my correcting entries, the first thing that you see, the fair value. So if you may remember, in my word, I have already put the investment in associate at using equity method, and there is a carrying value for the associate, right? So carrying value of the associate prior to remeasurement. So how much is that? 4.3 plus 0.5. 4.3 plus 0.5. Okay. Fair value of associate after remeasurement is this figure, 7.1. So fair value gain on remeasurement, 2.3. So this is also something that's not been accounted for. I will quickly account for it. Okay, I'll quickly account for it. Okay, so first I'll finish the whole associate mishap that they have done. I've already done 2 entries. Okay, so as we can see, Egap company has acquired Bryn company at the year end using step acquisition. It will be required that a fair value measurement of the existing investment is done. Subsidiaries, quoted share price at that date will be used for the same. Okay, so I'm going to do debit investment in associate to the extent of 2.3 million. Oh, why is it bouncing back? I don't know. Oh, a noise one. Wait. Yeah, these are some challenges that, sometimes once in a blue moon could happen in the exam day also, where the screens are not cooperating with you. You have to tell your invigilator immediately so that you get additional minutes, right? You get additional minutes if you report it. If you don't report it, then it goes unnoticed and there's no helping. There's no way you get any help. Okay, so let me close this and then retry it. Yeah, okay. So closing and reopening worked. Okay, so 2.3 million and credit fair value gain on remeasurement. Okay. Again, if you see that I have a PNL item coming and I have to be very clear that where is this item going to go. So in my PNL, it's going to go to my investing activity. In my balance sheet, this is going to impact my retained earnings. Okay. So you just need to be very clear with this. Okay. The fair value gain of 2.3 million will be recorded in the investing activities in the PL and will increase the investment in associate in the balance sheet. So I'll immediately do this. So my investment in associates increases by 2.3. And in my retained earning also, I have a 2.3 impact. Okay. Now, my comparison starts. Okay, my comparison again starts. So I want to quickly assess what is wrong that has happened. If they have missed recording this in the goodwill calculation, then they have not performed the basics rules of consolidation, which is also canceling of investments, So you remember the first rule of consolidation is you cancel investment in subsidiary because you cannot show investment in your own self. Now, if you see in the question, they took the cash element properly. Which means they did the cash element cancellation properly. What they did not do though is the existing fair value of investment. So if they did not take that in goodwill, they did not even cancel it off. Even same goes for share capital, share premium. They have not taken care of that as well. Okay. So we will do that. So what I'm going to do is I'm going to make a correcting journal entry before going to my pre-populated. For the goodwill impacts, I'm going to make a correcting journal entry. So I'm going to do a credit investment in associate and remove it from my books. Credit investment in associate and remove it from my books. To what extent? To the extent of 7.1 million. Because this was missed, right? Now in purchase consideration, cash was already taken care of. If you see in the question, they did it. What they did not do is a share exchange. So they did not completely record for it. So I'm going to record for it. So credit share capital, how much? 1 into 1, because 1 is your nominal price, and credit share premium, so that's going to become 1 into 2.2, because they said the fair value was 3.2 and 1 being the nominal value, I'm going to give the extra to share premium. Okay, then what's been missed? The NC has not been missed, but wrong value. If you see, it is at 8.6, but can you come to the question and see it's 4.2? So how much is the difference? 8.6 less 4.2. 8.6 less 4.2. So NC has been recorded short of 4 million. Now, y'all think and tell me, if NC has been recorded short of 4 million, should I do a debit impact of NC or should I do a credit impact in correcting journal entry? Should I do a debit impact or should I do a credit impact? Credit impact, absolutely correct. So I have 8.6 less 4.2. Just let me be sure. Yeah, sorry, it's coming up to 4.4, not 4. 4.2. And my NC again over here is a 8.6. So it's coming up to 4.4. Okay, not 4 million, 4.4. Maybe that was again a rounded off answer, but your proper answer is a 4.4. Okay. Now, so this has been corrected. Now, what else is there? So I've corrected till NCI. Now, net worth was correctly done here, correctly done. So correct in my correct journal entry, it's 14. What they have done is also correct, negative 14 million. So it's correct. Now let's look at our goodwill. So goodwill is 19.98, whereas it's 5.30. So goodwill is 19.98 less. So goodwill has been recorded short by 15 million almost. Could be a rounded off answer, but almost by 15 million. So can you all tell me if they've recorded goodwill short by 15 million, should I record this on the debit side or should I record this on the credit side? Should I record this goodwill on the debit or should I record this on the credit? Debit. Absolutely correct. So debit goodwill. So I'm going to do this. Take 19.98 less what's in the question, 5.3. So I'm getting a 14.7. There you saw I was getting a rounded off answer. Okay. Now I would want to just tally and see my journal entry if it's matching or if something's been missed. So yeah, this is again a rounded off answer, but mostly it's coming to 14.7 only. Let me check in this column. Yeah, can you see? The credit legs are also matching and it's coming exactly as 14.7. So I have a proper correcting journal entry form. Wait, what just happened? It's very off. I mean, I don't know why this thing is behaving in this manner, but then this is really risky to cut and paste. So when I do a control X and when I do a control V, can you see it's goofing up with the formula? So ideally this should not happen. Like not that in the real exam this will happen, but be careful just in case this is happening in the real exam. Be careful and then maybe don't care about the presentation that okay there are two lines up. Just let it be there. If you have done your correct calculations, just let it be there. Right now, I'll just have to like quickly just redo this. This is fine. I can do it. That's not a problem. Less 5.3. Investment in associate is 7.1. Share capital is going to be 1 million. This is going to be a 2.2 and NCI is going to be a 8.6. So I'm not going to link the cells right now because it's acting a little off for me. 8.6 and 4.2. Okay. So I might not just care about this whole presentation thing. Can I cut the cells? I'm just going to leave it like 2 lines extra doesn't matter. Okay. So it's correct. Okay. Now I'll go and quickly adjust this in my pre-populated. So in the exam, doing this correcting journal entry is not required till the time they don't ask for it. Okay. But for me, once I do the correcting journal entry for us, putting all the impacts in spreadsheet becomes really a piece of cake then. So now I have to see, okay, you know what? A goodwill addition is required, 14.7. So I'm just going to do that. 14.7. Then what else do we need to do? So remove the associate to the extent of 7.1 million. So remove the associates to the extent of 7.1 million. Then you have a share capital, share premium increase. So share capital 1 million and share premium 2.2. Share capital 1 million and share premium. So I'm going to put it in the other reserves 2.2. And then I have a non-controlling interest of 4.4. So to the non-controlling interest 4.4. So I'm going to do a sum of all this then. So this is coming up to 7.6. Okay, I would want to check my debit side also. Yeah, it's coming to 7.6. So you know that everything that you have done is correct. So I've pretty much catered the requirement of the examiner. What was the requirement of the examiner? Using Exhibit 1 and explain with calculations how to correct the treatment of investments in Bryn, which we did it along with explanation. So we did the calculation, explanation, and impacts in spreadsheet. So we catered like the requirement C also for that. Then it also asked your answer should include the revised calculation of goodwill arising on the acquisition. So I did the calculation, I did the impacts, but I need to do some explanation around it, which I will do quickly. Okay, which I will do quickly. So I'm going to open my Word and yeah. So Ria, if you want, like if you end up literally doing everything in one column as adjustment, but if the examiner can see like, so retained earnings will have too many adjustments, right? So if the examiner can see separate adjustments that you have done in retained earning, you can't do a clubbed answer on calculator and put in retained earning. No, that won't fetch you marks. So you have to show each and every adjustment in retained earning in that single column, right? In that single cell at least. If you're doing it in that form, then it's fine. You can still get marks if you do all adjustments in one column. Otherwise, group it. So exhibit 1 could be one column, or even out of exhibit 1, one type of adjustment could be in one column. The other type of adjustment could be in the next column. Okay, I would say segregate and grouping. Okay. So Salim, the recording of this is going to get uploaded on YouTube. It's going to be freely available. So for any missed content here, you can very easily go and follow YouTube again. Okay, that shouldn't be a problem. Now I'm going to explain the goodwill part. So goodwill was calculated. using the cash element as purchase consideration, cash element only as purchase consideration. However, as per IFRS 3 business combinations, it will be required that fair value of the total consideration be taken into account while acquisition of goodwill. This means the fair value of share exchange at the should be incorporated. Secondly, as this is a step acquisition, fair value of existing shares, fair value of existing investment should also be reassessed. As NCI, can't go at the bottom. So as NCI is being measured using fair value method, the quoted price of Bryn company at the year-end date should be taken into account. Okay, so I've given enough explanation. Now I'm going to cancel this and go to the next exhibit, the defined benefit plan. But before that, I'll quickly read the requirement around this. Okay, so it says, using Exhibit 2, explain with calculations and in accordance with IAS 19 employee benefit how to account for the defined benefit plan in consolidated financial statements for the year ended 31st December 2027. So completely shifting to IAS 19 topic now. Requirement A was completely around your whole acquisition, which is now sorted. Okay. So I'm going to move to this now. Now it says Egap has a defined benefit plan for its employees. On 31st December 2006, a net defined benefit obligation of 7 million was reported as a non-current liability in the consolidated statement of financial position. Okay, this is at 31st December 2006. And when are you making financials for 31st December 2007? So for me, this 7 million becomes my opening net obligation. Okay. Now, it says on 1st April 2007, the plan was amended to provide additional benefits with effect from the date. The present value of the additional benefits on 1st April 20X was 4.2 million. Okay, so now it started to develop that whole opening closing walk. If you all may remember, for the defined benefit plan, you will be maintaining a fund. You'll be maintaining an assets fund from which in the future you will be able to pay the benefits to the employee. So you don't report the asset and you don't report your liability towards the employee separately in the financials. You report a net position. So if assets are less and if liability is more, you club them together and it will be showing a net defined obligation position in the balance sheet on the liability side, right? But let's say if assets are more, then it will show on the asset side. But never normally it will happen. It's not a normal circumstance where it will happen, so that the assets are high in value and the obligation towards that employee is lesser. That normally never happens. Your whole scheme is always in deficit, not surplus. It's always in deficit, not surplus, right? So you'll always see your balance on the liability side. So this 7 million is your opening liability position. It's a net figure though. The assets impact is also lying in there and it's a net figure. Okay, so you're starting from there and then you'll reach a closing figure. Who is going to provide you with the closing figure? Can you all tell me who will actually provide you with the closing figure in the real world? Who provides with that closing figure in the real world? Actuaries will provide it. Okay. So what you will end up doing is a whole opening to closing work. You have an opening figure of 7 million. You will see in the current year basis, whatever employees are staying and whatever is the obligation because of that, you will calculate the expenses, that how much this liability will increase because of the people serving in the current year, right? It's an accruals basis concept, right? You record items basis accrual. So if people have given you service, of course, this liability will increase. So you will calculate that, you will add to it. Okay. Then you know that this figure opening balance is at a present value. So it will get unwinding. So finance cost will come in picture. Okay. Then there is a possibility that there is a change in the way you are calculating. There is some amendments in the plan, right? So maybe you're giving more or increased benefits. So then because the people have provided services in the past, and if the policy is increased, it's a retrospective impact. So that's why what is happening is that you are having an increased expense figure as a result. You're having an increased expense figure as a result. So it's a past service cost that you will add to it, which is again a P&L impact. Then you will also have if let's say you're making payments to the employees, there's a contribution, so they will drop this, they will drop the opening liability, right? They will drop your opening liability. So you did a credit bank, but debit is your liability. Your liability is getting dropped. So you have your cheat sheet for IS 19, right? You have your cheat sheet. That whole opening closing walk is there. Now whatever calculations you did from opening till the end, whatever you're doing, all the movements, club them together. If that figure doesn't match with the actuary figure, which will not, it won't match. Your calculations and actuaries calculation won't be the same, right? You will have some calculations, actuaries will have some calculations. They are much more experts in this, so their calculation is taken as the final calculation. So you'll try to match it and it won't match. So whatever difference is there, it's a remeasurements difference sitting in your OCI. So all that keeping in mind, now I'm going to do this situation. But what I'll do is, because I've been asked to do a recalculation, or I've been asked to do a calculation and explain it, I'm already going to start to do it. Okay. So I'll take my spreadsheet and I don't have separate sheets, right? So it makes things a little difficult for me to do in Word. So what I can do is maybe I can write over here specifically Exhibit 2. I'll write over here Exhibit 2. And then maybe this could have been named as Exhibit 1. So all these calculations that I was doing is working 1, but it's also Exhibit 1. So there's no confusion. Okay, so in Exhibit 2, I have my opening net liability as 7 million. Okay, now let's see what's happening to it. So they said that the plan was amended with effect and the present value of those amendments are 4.2 million. So because you made amendment, increased costs are there. So add past service costs, 4.2 million. Now, I want you all to same time think of the impact also in the PN, or whether what is the other impact, like this past service cost in the opening closing work, fine, I'm going to add it. But is there any other place that it's going to go? Is it going to go in my PNL? Yes or no? Is it going to go in my PNL? Yes or no? Is it going to go in my PNL? The past service cost 4.2 million. Yes. Which section? Because now IFRS 18 tells you have to tell a section. Which section? Michelle is saying financing. Monmouth is saying operating. What about others? Which section is this going to go in? It's going to go in operating. It's going to go in operating. This is on your employees. So it's operating activity, the past service cost. Where do you record your salaries? Operating, right? Expense of employees, past service cost. Okay. So operating. Now, next. After the amendment, the plan was determined to have a net obligation of 12.9 million. So after this amendment, they're saying the obligation was supposed to be 12.9. Now, when I do a sum of this two, I see. Okay, so first is, let me put the two dots. So I see 11.2. I don't see the figure that they are showing me. I don't see a 12.19. So I'm going to read further. I don't know what the error is or what it is, right? So I'm just going to continue to read further. because there is no place right now where I can fit this 12.19 as per my regular format. So I'm not going to stress about this. For now, just park it. Okay. I just saw the figure does not match. Let's just park. Let's see what we'll do with it in the future. Because of the improvement in terms, the monthly service cost changed from 0.3 million before 1st April 20x7 to 0.35 million per month after 1st April 20x7. So what's happening is you have a monthly service cost because employees are working in the current year, so of course you're going to incur more expense. So till before you made those amendments, it's 0.3 per month, but after that it's become 0.35 per month. So January, February, March, okay, 3 months it's 3 million, then remaining 9 months it's 3.5 million. So 3.3 million and 0.35. So current service costs 3 months, first 3 months. 0.3 into 3. Sorry. Yeah. Now I want you all to, before I read further, I want you all to think again. What is the place? Will they go in PNL? Yes or no? Quickly. Will they go in PNL? Yes or no? Yeah, you can write it in single line. That's not a problem, dear. Yes, they'll go in PNL, correct. Which section of PNL? Which section of PNL? Operating, investing, financing, taxation, discontinued operations. Which one? Operating. So correct. They are all going to go in my operating. They're all going to go in my operating. Somebody asked if we can do this together. It's okay. You can do it together. That's not a problem. Okay. Now, next one. The interest rate on high quality corporate bonds was 5% on 1st January 20x7, but this rose to 6% on 1st April 20x7. So for the first 3 months, you had that unwinding at 5%, but for the last 9 months, it became 6%. No problem. I'll do that unwinding. Because I want to. So annoying. Why is this happening? I do a control X, control V, it will just copy and put it down. It won't, cut and paste. Okay. So anyway, add finance costs or add unwinding for 3 months. So I'm just going to do the unwinding for 3 months because I have a different rate. So 7 million, the present value is going to get unwinded using the 5%, but only for 3 months. Okay. Now, if you may check the sum of what I have right now over here. 7 plus 1 plus 0.9, the past service cost, plus the service of 3 months. So I'm doing everything till 1st April that is come into picture. 1st April. Wait, something's wrong now. Wrongly calculated. Because when I did that control X, control V, something shifted. So unwinding is this. My past service cost has changed, I think. My past service cost was how much? Sorry, the wrong foot. My past service cost was 4.2 million. So that's changed. So I'll correct it. So don't panic thinking this can happen in the real exam. Least chance, but it can happen. And if it's happening, just like I said, let the invigilator know that your script is behaving a little off when you do control X, control V, control C, control V. So you are considered that way and you get additional time. If you don't report it, then nothing goes in the ACCA's records. And if at all there are any grace marks to be given considering your situation, that won't take place because you never informed anyone. Okay. You never informed anyone. So anyway, now can you see that when I do a sum of 7, 1, 4.2 and 0.9, everything till 1st April, I have a figure of 12.19. And if you may remember, they also gave us a figure of 12.19. Now, right now it's matching. So at least we know that, okay, whatever figure they had provided and whatever we got by our own calculation is matching. It's same. Great. Now, what else do they have? What else do they have? So we have at 31st December 20x7, the actually valued the net defined benefit obligation at 10 million. At 10 million. But I also have to cater the 6%. I also have to. Okay. So I'll just cater that 6%. So when I'm going to do the 6%, I'm going to do it on the fresh present value. So I'm getting it as 0.5. And then I have my closing net liability, which is 10. So I'm going to do a sum of all this and check where is it standing. So if you can see, it's standing at 16 million, quite far. Let me just make sure if everything is correct though. Okay. Okay. There's more to it. One second. There's more to it. Okay. So if you may see that the actuary valued the net defined benefit obligation at 10 million. Fine. I have punched my closing. Okay. I have done unwinding. There's one final line also. There's one final line also. The only accounting entry posted in the year in respect of the above was to recognize the cash contributions of 4.1 million paid into the pension plan on 31st December 2007 in the consolidated statement of profit or loss. Just one second, please. Just one second. I have to just take a 2-minute break. My daughter is there. Okay, sorry. So yeah. So like I was saying, we were on the last leg of this. So it said that the only accounting entry posted in the year in respect of the above was to recognize a cash contribution of 4.1 million paid into the pension plan on 31st December 2007 in the consolidated statement of profit or loss. Now think about it. If you're making a contribution, if you're going to make a contribution of 4.1 million to my opening closing walk, what is this going to do? Will this have an impact, yes or no? To my opening closing walk, this that I'm doing right now, will it have any impact? Will it have any place or no? Yes, the liability will reduce. So if you're making contribution to the asset, your asset is increasing, and as a result, your liability will drop. So that's fine. Less contribution I'll do. Which is, just want to be sure. 4.1. Okay. Now I'm going to do the remeasurement. So from 11.79, it's dropping and it's becoming 10. So can you all tell me that is this remeasurement leading to a gain or a loss situation? Is this leading to a gain or a loss situation? When I club all this above, I have 11.79 and my closing liabilities are 10 from actuaries. Actuaries has given me a figure of 10. So is there a remeasurement gain or a loss? It's a remeasurement gain. It's a situation of a remeasurement gain. Absolutely correct. So I'm going to take this 10 minus the sum of everything above. So I have a remeasurement gain of 1.79. I have a remeasurement gain of 1.79. Now, what does it say? See, for me, one is I've just simply calculated whatever was the right thing to do. But another important aspect always in your first question is what has wrongly been done, reverse it, pass the correcting journal entry, not something from scratch, right? Pass the correcting journal entry. So they said that the only thing that they have done, the only accounting entry posted in the year was to recognize the cash contributions paid into the plan in the consolidated statement of profit and loss. Think about this. The contributions that you have paid, does it have any place in profit and loss statement? Opening closing walk, you told me yes, and I took it. But in the P&L, does it have any place? In the P&L, does it have any place? No, because it's a cash element. You have done a credit cash, so you have spent it money, and debit was your asset. Debit was your asset, right? So, or sorry, debit was your liability going down. Sorry, liability going down or asset increasing, whatever. But debit is not leading to a expense element. Debit is not leading to an expense element, right? So for me, I have to be careful. I have to be careful. And what I'm going to do is the correcting journal entry I'll pass away here. The correcting journal entry I'll pass away here. So it's going to lead to a drop in my net obligation 4.1. And what wrong they had done is they had put it in the P&L as expense. So I'll reverse the P&L impact. Which is nothing but retain earning. So I'll do this quickly in my pre-populated. Okay. So where's my pre-populated year? And I want to do a 4.1 to the net obligation and P&L. Sorry, just have to go above. So I have my obligations over here, right? So I'm going to drop this by 4.1 and increase the retained earnings by 4 point. So this is my net defined defined benefit. Wrong entry that they had done. So you can name it anything. Like you really don't have to go this big. You can just write net defined benefit and put all impacts here as well. That's also okay. That's completely okay. Okay. So this is one impact that I've done. Now, what about the others? If they've just done this much, what about the other items? They've not taken care of the other items at all. So I have tagged few items as operating. What about this unwinding? Unwinding of interest, where is it going to go and sit? Can you all quickly tell me? Where is the unwinding of interest going to go and sit? Profit and loss statement, but where in profit and loss statement? Can I just say profit and loss statement now? No, I have to be very specific and say that this is going to go and sit in my finance costs. Absolutely correct. So, or financing activities. Okay. What about the unwinding of the remaining 9 months? Same thing. Okay, financing activities. This is not sitting in my P&L, so not in PL. And this remeasurement gain, can you all recall and tell me where is this remeasurement gain going to go and sit? I'll pass this entries. Now, for financing, what will I have to do? See, even if it's financing or operating, in the balance sheet, can you all tell me where is it going to go and sit? Whether financing or operating, I don't have a PL right now that I can segregate and put it in places, right? But what I have is a balance sheet. So whether financing or whether operating, where in my balance sheet is the impact lying? It's lying in the retained earnings. So all these financing and operating, I'll check the sum and give one impact in my retained earnings. So this is standing to 9 million, but maybe a rounded off answer could be something else, right? So I have to give a debit retained earnings of 8.89. So when you're doing a debit retained earnings, can you all tell me what the credit leg is going to be? Where is this going to go and sit? What is the credit leg? Debit is retained earning. I'll go and I'll drop 8.89 from retained earnings in the pre-populated. Where is the other impact going and sitting? Where in my pre-populated should I put the other impact? I will go to my pre-populated. I'll do a less 8.89 over here. Okay. I'm going to go and I'm going to do a less 8.8 over here. Missed impacts. I'll write net defined benefit, missed impacts. And I'll say, okay, you know what? I need to put in the retained earnings 8.89 expense. What about the credit leg though? The credit leg is the liabilities, the net defined obligation, right? So that is the other thing. So 8.89 over here. Okay. Next. So I've catered all this. Okay, I've catered all this. The not in P&L item has also been catered. What about 1.79? This is a OCI. So this is a gain though for me. Okay. This is a gain. So credit is so OCI items from OCI will go in the other reserves. So I'll put it in the other reserves. And debit is going to be what? Can you all tell me what is debit over here? Can you all tell me? Yes, absolutely correct. Net obligation. Perfect. So that's 1.79. 1.79. So go to your other reserves. 1.79 in the other reserves, and to your liability side, add it. Or rather deduct it. Now it's going down, right? So sorry, deduct it. So you can check the sum of this. Is it 7? Wait. And then what do I have over here? Do I have anything? No. So ideally, this should have gotten negated. Yeah, so this is a negative sign. The 8.89 that we had done over here was a negative sign, no? We're reducing the retained earnings, right? Because we're booking expense, we're reducing the retained earnings. That's why this cross-checking will always help. So you can see I got a 7. If I do a rounding off, it would be 7.1 only mostly, if you can see. That's why we do that checking, always cross-checking. Now, if you want, you can do a adjusted closing balance column or adjusted column. If you don't want, you cannot do it also, because what will happen is you will just do a sum of all this and then you will check the total if it's matching or not matching. Individually, you have any which ways checked it is matching. So for sure it's going to match. But you can also save this time and not do this at all because there are no marks for this, right? There are no marks for the final column of adjustment. There are only marks for these adjustment columns. So you can completely skip it also. It's okay. I'll choose that time to drafting my answer. Drafting my answer regarding what? I have to also give explanation around this, right? I have to also give explanation around this. So I'm going to quickly, develop my answer for this. The only catch that I see here is that how do I use this? It's giving me a tough time. The sheet is giving me a tough time, right? So maybe I'll just copy this and delete it. You all will have it secured, just don't worry. Just try my luck once more. It won't come. No problem. So the B answer. I'll refer spreadsheet to develop the answer. I'll refer the spreadsheet to develop the answer. Okay. So I'll start with where it's supposed to be presented. So I'll write that as per employee benefits standard. You need to record a net position. It could be deficit, it could be surplus. Most of the time it's deficit. And even in this current case, it is a deficit and it will be recorded in the liability side. Now, by the year end, this figure will change because employees would have continued to work for another more year. So there'll be more recording of expense. There'll be unwinding of interest. The payment will drop this obligation, and then you'll have a closing liability. However, the closing liability will come from from the actuaries organization, where we will try to match our figure with actuaries, and accordingly a remeasurement will take place. So we'll quickly explain all of that. Okay. Yeah. So as per IS 19, a net position of defined benefit should be presented in the financials, which can be deficit or in surplus. However, as most of the times, the liabilities will exceed the assets. Therefore, it will be a net obligation position presented on the liability side of the balance sheet. Okay. Now, this position is the present value of the liability and the assets. Hence, unwinding is required. As there was an amendment on 1st April, this has led to an increase in the past service costs and will be added to the opening balance. The current service cost for the first 3 months is different as it was prior to amendment and should be considered and should be taken into account, right? Okay. Now the interest rate prior to amendment was 5% and same should be taken on the present value of the net position on 1st April. However, after that, on the position of 1st January 2027. However, after that, the revised interest rate should be taken, which is 6% on the figure of 1st April 2027. Okay. The opening balance along with the movement is higher than the figure that has come from actuaries at the year end. Hence, this is leading in a remeasurement gain of 1.79 million at the year end, which will be recorded in the OCI and finally to other reserves. I just want to be careful and make sure that wherever a PL mention is required, I'll do that along with the specific place in the PL, right? So we have not done that precisely, right? So when taken in, okay. Now the present value, as there was an amendment, there's a lead to past service. Okay. Now these past service costs. So where I'm talking about past service costs, I'm just mentioning these past service costs will be recorded in the operating activities of PL as expense. Then when I'm talking about current service costs, I need the same statement. So what I can do is see. These past service cost and current cost. I'm just adding the word current cost as well. Okay. Don't want to keep writing similar stuff again and again. Okay, so just segregate it for you all. The current then I'm talking about interest rate. the interest rate, the unwinding of the present value will be recorded in the financing activities of the profit and loss. Okay. So I just made a mention of the current service cost for the first 3 months is different as it was prior to amendment should be taken into account. I can continue and write that after amendment it was different and then should be taken into account basis whatever is 9 months, but not really required. Like if you want, you can, because idea is they're not going to check that if you have, in the written content, if you have mentioned each and everything, they're not going to check that because that's not the kind of marks that they have allocated, right? It's just worth, if you may check, this is just worth a 8 mark, right? This is just worth a 8 mark. So whatever calculations you have done, it would be a good 5 to 6 marks already. So they are not expecting a lot of written content, but yes, do give decent points. So like that, if any 1 or 2 point missed, not for every item if you're writing, it's completely okay. It's completely okay. Remember, you want to pass the paper, not get perfect, 100%, up to date answers every time, right? Because if that's your focus, then you're losing the easy marks there. Now, when the examiner starts checking this, so he has checked your numerical, he's given you marks, and he's probably given you already a good, 5 to 6 mark there. Now, when he's checking this, somewhere up until this step only, he's probably given you another 2 to 3 marks. So he's going to write over the max, meaning he's not going to be in a position also to give you any marks for this final line, because he's going to be like, I've awarded you already maximum marks. So what's the point of just writing and writing and writing and giving the, like, they're not even perfect, they're like, you're right, you're doing more than what is required, so you're losing the easy marks that are there in the other areas, because eventually what's going to happen, your timer is going to stop, your 3 hours 15 minutes are going to get over. So what's the point of doing this extra writing, right? So you need to take a good stop also. Okay. Now, yeah, with this, I'm done with the first question, guys, which was on groups. Yes, it's a little intensive always, but understand that if you have done enough practice, it's not going to be difficult. And then you also have to know the technique. What is the technique? Uh, Doing the right thing. Okay, goodwill calculation is done in this manner is not always difficult. That's still fine. You know how to do a goodwill calculation if it's straightforward. Share capital, sorry, purchase consideration, add NCI, less net worth, you get your goodwill. If it's step acquisition, then you take your fair value of existing investment. Then you still have your purchase consideration. You add your NCI less the net worth, you get your goodwill, right? So the doing from scratch is fine, but identifying what is wrong and giving a correcting impact, that's always a little bit twisted. But now that you know the technique, that you have to very clear cut identify what's wrong, reverse the impact of that. If there is any missing impact, do those impacts. Like if you have that technique, then those fresh questions that keep coming in the exam, they should not, be like a nightmare. They should not be like a nightmare. Okay. So any doubts in this question, guys? Any doubts in the first question? We will also be doing ethics question, which is the next question, but we'll take a small break and then continue. Okay. So the Excel sheet and the Word document, what we'll do is I'll ask the team wherever the YouTube lecture is going to get uploaded to share a link, okay, for the Google document, and there from there you can take it. That's fine. Okay, you should be able to take it from there. And all those students who are paid students, you all will get it on the portal uploaded. You all will get it on the portal uploaded. Okay. So I believe no doubts, right? So we'll take a break. Now I would want you all to put a 15-minute timer on your stopwatch. So it started like at, don't look at my clock, this is as per Kuwait, but UAE 2 p.m. It started at UAE 2 p.m. You can see we've been doing it for the past 1 hour 48 minutes. We've been doing this sum for past 1 hour 48 minutes. So 15 minutes timer and then we get back. Okay. So next question, like I said, is float, which is on ethics. Ideally, my screen should be visible. I should be audible. My video should also be visible. Okay. Just need this to go away. This wouldn't go away. Yeah, I can go away now. Okay, great. So I'll read the background, I'll read the requirement, and we'll get into the exhibits one by one. Okay. So it says Byfloat operates in football industry. It prepares its financial statements. One second, just let me be sure it's question number 2. Yeah, it's question number 2. It prepares its financial statements using IFRS accounting standards. The financial year end is the 31st December 20x7, the same financial year end which we had in the previous sum. Okay. The following exhibits available on the left-hand side of the screen provide information relevant to the question. The first is on financial assets, provides information about financial assets held by Byfloat. When you hear the word financial assets, which standard comes to your mind? I just need the number. Which standard? Put in the chat box or unmute and tell me, that's fine. Which standard? IFRS 9, absolutely correct. Second is ethical issues, describes issues facing Byfloat's new chief accountant. Okay. Now, this information should be used to answer the question requirements within the response option provided. I'm going to read the requirements. In accordance with IFRS 9 financial instruments, discuss the accounting treatment of the transactions in Exhibit 1 in the financial statements of Byfloat for the year ended 31st December 20x7. And B, it says, using Exhibit 2, discuss the ethical issues raised by the scenario and the actions that Ms. Hayes should take to resolve these. Okay, fine. So first is around Exhibit 1 and ethical issues are clearly around Exhibit 2. So we're not going to bother for this requirement right now. We're not going to bother this. We're just going to focus on A now. They say discuss. The key word in the first question is in accordance with IFRS 9, discuss the accounting treatment of the transactions in Exhibit 1 in the FS of Byfloat. Okay, so they're asking discuss, and right now I have no hints that I have to calculate as well. Okay, so I'll just give you all a heads up. It's highly discursive only. There are no calculations really in this first questions, and this is going to finish real quick. So you all have to be just patient for another 30 minutes, and I think we are done with this session. Don't worry. It's not a long session anymore. Okay. So the first exhibit says, Byfloat acquired 5% of the equity share capital of Veleta company some years ago, but did not make an irrevocable election at the initial recognition date to measure the investment at fair value through OCI, other comprehensive income. So you all may remember that in IFRS 9, under financial instrument, you will have two categories. One is your financial assets and the other is your financial liabilities. Under financial assets itself, you will have further two categories, which are your equity-based instruments, and then you have your debt-based instruments, right? You have two categories. Now, when they say we acquired 5% of the equity share capital of Veleta, but we did not, we did not make any election that we are going to use OCI method, then first of all think and tell me that is this a equity instrument or is this a debt instrument? What instrument is this? Put in the chat box quickly. If you're investing in the equity share capital, it's an equity. Perfect. I mean, no rocket science here. It's equity. But in equity, depending upon the intent, it can be fair value through PNL and it can be fair value through OCI. So can you tell me that is this fair value through PL or is this fair value through OCI? Okay, great. This is fair value through PL because they're deliberately saying that it was not chosen to account as fair value through OCI. Okay, so if not choosing or not deliberately calling it out, then you know that the default position is going to be always fair value through PNL. Okay, then they say, subsequently, Veleta experienced significant operating losses and Byfloat provided a substantial loan to Veleta on normal commercial terms. Okay. So this organization, which has invested in Veleta by giving money and taking shares, also helped this organization Veleta in another form by giving loan. So it has loan notes also, or it has loan also with this organization. Okay, and on normal commercial terms. Now, on 1st January 20x7, Byfloat still held the 5% equity share capital of Veleta in addition to having a significant loan. So at the beginning of the year, it has two things. It has investment in shares and it has investment in loan notes also. So one, we already cracked as an equity instruments. Can you all tell me the other investment that we have done, the loan receivable? Is that an equity instrument or a debt instrument? Can you all tell me? We have two instruments right now. So one is, you all told me it's an equity instrument. What about the second one? Is that an equity instrument or a debt instrument? It's a debt instrument, very clearly. It's a debt instrument, right? and was correctly measured at amortized cost. So if they're telling us it's correctly measured at amortized cost, then it is the amortized cost method. So you all know that in debt, you can have fair value through PL if it's for trading. You know, if you intend to hold it till the redemption date, till the long-term redemption date, right, then it's going to be amortized cost. But if you plan to hold it till redemption but may sell in between, then can you all tell me what is the third category here? Can you all tell me the third category? If you plan to hold it till maturity but may sell in between, can you all tell me what is the third category? It's a fair value through OCI. So they clearly told us that, well, it's correctly kept as amortized. Okay, no problem. It's correctly kept as amortized. Great. Now, at 31st October 2007, so if you can see good like 10 months have passed, Byfloat agreed to write off half of its loan to Veleta in exchange for a further 10% of the equity shares in Veleta. So what it's saying is that Byfloat is saying, okay, in my books, I have a loan receivable. Let's say a loan receivable of 2 million. Okay, example. I'm just giving an example. Let's say they have a loan of 2 million, loan receivable of 2 million. They're saying we will write it off. We will write it off till the extent of 50%, but in exchange of a further 10% of equity shares. So they're going to they're going to write off loan. So they're going to lose on the loan receivable. The loan receivable, which was an asset, will go down. So that's why I'm putting it on the credit side. Okay. But in exchange of, again, investment in shares, or I'll say financial assets. Okay, so one thing is going out and the other thing is coming in. Okay, no problem. But is there a problem? Let's read. The fair value of the shares received in exchange was considerably lower than the carrying amount of the loan receivable. So, for example, if you have written off a loan of 1 million, 50% of this, right? Example, I'm saying 50% of this. So I wrote off a loan of 1 million. They're saying that the investment in exchange that you're doing is of 0. Let's say 7 million. It's a little lesser amount. The shares that you're getting in exchange is of a little lesser amount. So of course your journal entry is not matching. Is not matching. Where is it not matching? On the debit side, it's less by 0.3 million. On the debit side, it's less by 0.3 million. Can you all tell me where can I park that 0.3 million? Where will it go? Can you all tell me where will that 0.3 million go? Investing section. Okay, that's fine. But what is the nature of this item? What is this? What is the nature of this item? What is this? It's right. Michelle is right. It's a loss. It's a loss on the investing side. It's a loss on the investing side. It's a loss on exchange. Okay, loss on exchange. And this is the deal. Okay. So this is what you're going to do. And then it further says, on 31st December 2007, Valletta was unable to repay the interest falling due on the remaining loan. The 50% loan that you still have as investment, you're not receiving any interest income. So, not receiving an interest income, what does it ring? What bells does it ring? Not receiving interest income, what bell does it ring? You have loan receivable. You have loan receivable. What should you do? What should you do? But you're not receiving interest income on it. It's a credit impaired item. It's a credit impaired item. So do you know that IFRS 9 tells you that you have to check for impairment? You have to record expected credit losses. If the risk is low, then do a lifetime of recording. But if do a 1 year of expected credit loss recording. But if the risk is high or credit impaired, then do a lifetime. So in this case, by the time year end has come, by the time 31st December 2027 has come, we're going to record a loss allowance up to lifetime. Okay, so all this we have to explain. So basically, first is we are going to explain a transaction. Okay, the exchange transaction that is going to take place. Then we're going to explain that how to, okay, order could be anything. Idea is what all items are coming in picture. There is an exchange transaction that is coming place. So you explain the transaction that you're writing off a loan of a higher amount, but in return getting investment of a less amount. So the difference will sit as a loss in investing activities. That's fine. That's one thing, one aspect. But then there are so many other things, like you identified that there is an equity instrument. You identified there is a debt instrument. So initial measurement of equity instrument, subsequent measurement of equity instrument. Where does the difference go? Then debt instrument, initial measurement of debt instrument, subsequent measurement, recording of impairment losses on it. How do you record it? 1 year, all this is going to fetch you the marks that are required. The good part is, I'll say the good part is no numerical required. So you're just going to just quickly explain the concept and get marks. 8 marks, very easy marks, I would say. 8 marks, but very easy marks. Okay. So start drafting the answer. So they started with investment in shares. And then they said that they also made a loan note issue, right? So, like I said, the order could be anything, but you have to touch upon everything: measurement of shares, measurement of the loan notes, and the share exchange. So, I think I'm a little more comfortable by starting with shares because that's the first thing that's starting in question, right? So, let me put it in that fashion, okay? So, investment in shares. As per IFRS 9, investment in shares is a financial asset equity instrument. The default measurement technique for the same is fair value through profit and loss, unless it's explicitly called out that it will be measured using fair value through OCI, or the intent is long term. As no election of measurement was made, it will be recorded at fair value initially. At the year end, a remeasurement will be required. Can you all tell me at the year end when the remeasurement will be required? At what value is it remeasured at the year end again? And it will be measured at, can you tell me what is this at? Fair value. So again, if you're going to take fresh values from the market, fair value, fair value, if you're taking fresh values from the market, then there'll be a difference. So where do you record the difference? Can you tell me where do you record the difference? Can you all tell me where will the difference be recorded? The difference on why OCI, guys? When they did not choose to elect it as fair value through OCI, the default position is fair value through PNL, then why do you all say OCI? PL, absolutely correct, PL. As the remeasurement will take place at fair value, the gain or loss will be recorded in profit and loss statement. So because when I did a share exchange is when the loan notes were issued to me. So I'll talk about that. One more thing you can talk about is the dividend payment, but it's also really in your hands how much deep you want to do the discussions. Okay, so if you're receiving dividend received, that's an investment income. You can talk about that also. Okay, that's up to you. Transaction of writing off. Wait, even before that, I think I had already entered into loan note, right? So loan note receivable. Just need to know the names of the companies, Byfloat and Veleta. Byfloat had also invested in the loan notes. Okay, there is no date given. It's just written subsequently. Okay, it's just written subsequently. No date given for loan notes. So I don't have really any note there. But at 31st October, they said it was written off, right? So okay. So Byfloat had also invested in loan notes. However, at 31st October, 28/7, as Velita was facing financial difficulties, it had to be written off in exchange of equity shares of 10%. The loan receivable given up was of a higher amount compared to the shares that were received in return. Therefore, it was a transaction made in loss, and the loss should have been recorded in the investing activities of P&L. Profit and loss statement. Yeah, so if you want, you can give a journal entry here, but really not necessary. Like you want, you can show where debit, investment, or financial assets, up to you. And then you can show a credit loan receivable. And then you can do a debit loss on exchange. You could fetch up to a 1 mark here. That's fine. Okay, now the pending loan, the 50% that I have, how do I treat that, right? So the remaining, I'll write it as remaining exchange and remaining loan. So the loan notes, I'll start the story with initial inception, okay? The loan notes are financial liabilities as per IFRS 9 and are recorded at fair value through P&L. The initial measurement is at fair value. Fine. Are recorded at fair value through P&L? No, this wouldn't be right. The loan notes are financial liabilities as per IFRS 9 and are recorded as per amortized cost model if they meet the criteria. Okay, if they meet the criteria, which is of holding the loan notes till maturity. The interest income will be recorded using the effective rate of interest. It is also required that they be tested for impairment annually and loss allowance be recorded basis the level of risk. Initially, default risk would have been low. However, by the year end, it increased and the asset became credit impaired. Therefore, loss allowance of a lifetime should have been recorded. So when you're saying Ria, the financial asset, is it not the loan note? So understand one thing, that you are dealing with two types. Okay. So if you want, so last time I wrote investment in shares and someone was more comfortable me writing as financial assets, which is fine. See, financial assets is a line item in the balance sheet, which could be made up of different types of assets. It could be investment in shares, it could be investment in loan notes as well. So where I clearly call out that I'm going to de-recognize a loan receivable. In return, what I'm receiving investment in shares. So these financial investments are actually precisely investment in shares. So it's not wrong to write it in this fashion, but I could write it the precise item investment in shares. I hope you're comfortable with this. Ria, I hope you're comfortable with this. So Michelle, I know that there is this tendency that, okay, you know what? Like whatever I'm writing, you know it. Like you have read it, you have come across this, so you know it from that perspective. But when you're doing it at the exam time, you know that there is a tendency that you might not be able to write, you know, so much of it, or you might have a tendency to miss it. That's why assignments and mocks are very important, because then you know that exactly are you able to recall at in the exam pressure, like in that exam style condition, are you able to recall? That's why assignments and mocks are very important. And understand the way to recall all this. How do I recall? So I have to just link it to the standard. Okay, which standard is this? IFRS 9. Which instrument in the scenario are we talking about? Are we talking about financial asset or a financial liability? So first understand that. Really go backwards. Financial asset. What type we have? We have a financial asset, if fair value through PL, fair value through OCI, right? If it's equity. If it's equity, then we have these two categories. So identify that, okay, that this is equity and you have two categories. So prove it in the answer that why is this equity, or you can just write that it's as per IFRS 9, investment in shares will be classified as an equity instrument. And because it's not elected as a fair value through OCI, default position is fair value through PNL. You have to go really backwards and recall your cheat sheet. I would say recall your cheat sheet. It will help you. It will help you. Oh, is it? Where have I written financial liability, dear? I just want to correct it because it's not financial liability, no? Where did I write financial liability? Oh, yeah, the loan notes are financial assets. Yes, absolutely correct. Thanks for bringing to my notice. The remaining loan notes are not financial liabilities. You have again invested it. So they are your financial assets only. They are your financial assets only. Okay, thanks for bringing it to notice. All right. Now, initially default risk would have been low. However, by the year end, it increases and the asset becomes credit. Therefore, loss allowance of a lifetime should have been recorded. Okay. The interest income will be recorded not on gross, but on the net figure. Okay. So I've written enough content. Okay. I hope you all have understood this as well. Okay. So now I'm going to go to the next requirement. Using Exhibit 2, discuss the ethical issues raised by the scenario and the actions that Ms. Hayes should take to resolve. So you have 10 marks for the points and 2 marks, which are professional marks. If you're relevant, if with clarity you have been able to provide the ethical, the ask which was around the ethics questions, which was one, identifying the issues and the actions both. So if you just do issues, let's say, for example, if you just do issues and if you don't cater the actions, then these 2 marks, professional marks, are there to cater that as well, right? With clarity that, okay, whatever the requirements are, you've done it. So you lose on that professional marks if you don't cater both, right? And the relevance over there is also highly important. Okay. So I'm going to identify issues and I'm also going to give action points. So let's come here. Okay. Now it says Byfloat has a football team in the top division of a national league. The board of Byfloat is dissatisfied with the football team's recent performance and has set out plans to borrow 50 million from the bank to spend on new players and facilities. Okay. So what has happened is Byfloat has a football team, but they're dissatisfied with the performance. That's why they're saying let's push in more funds so that we can spend more on new players and some facilities. So how much are they planning to borrow? They are planning to borrow a sum of 50 million. Okay. Now there is a new chief accountant, Miss Hayes, and she is ACCA qualified. She initially applied for a permanent position but was appointed on a 9-month temporary contract, which may be extended based on her performance. So there's one issue. This chief accountant who's been hired is a temporary position, 9 month, which means she really cares about her becoming permanent as well, right? She really cares. Now, immediately when you hear this statement, what do you understand? Miss Hayes position brings in what type of ethic could lead to what type of ethical breach with this statement that she's a temporary employee and she will definitely care about becoming permanent, right? So what type of ethical breach could come in future? Self-interest, objectivity, self-interest, objectivity. Yes, self-interest is a threat, but the ethics that could get breached, the ethics that could get breached is objectivity. She will be not be able to, be free from any bias and take a decision when she's taking decisions, because she'll care a lot about, what about my position? If I reveal this, if I try to push in the right treatments, if I try to not do what they are saying, which is the wrong treatments, I might end up losing my permanent position, right? So objectivity clearly is one ethical, thing which can get breached. Okay. Now she reports to the FD. Under pressure from the FD, Ms. Hayes has produced an optimistic analysis indicating that the 50 million investment will be worthwhile and will achieve the board's objectives. Now, what happens is that when you want to borrow funds, the financial institutions and banks will ask you cash flow projections, future cash flow projections, because this is a loan for a specific performance, right? Like you want to bring this football team up, you want to buy some new players, you want to improve on the facilities. So the moment you have this 50 million cash influx, what are the future projections? Where are the negative cash outflows going to be like? So you would show them. So the positive cash inflows, the negative cash inflows, and then how are you going to, make money? Positive cash inflows, how are you going to end up making money? All that you will show a forecast, right? Now they're saying that under the pressure of FD, she's happened to produce optimistic analysis. But Ms. Hayes is aware from recent press reports that similar football teams have had to spend significantly more than 50 million to achieve similar results. This analysis has not yet been sent to bank. So it's not been sent to bank yet. But Ms. Hayes is very much aware that, let's say, for example, she's showing an inflow of, so she's showing a borrowed sum of 50 million. And then other than that, other than the borrowing right from the core activities, let's say she's showing, okay, you know what, we're doing a spending of, let's say, 666 million, or let's say 10 million for the next 5 years. The inflow that started to come right from the third year, let's say, is another 8888 million. But well, she's very well aware that she's making a highly optimistic, cash flow projection, because not 50 million, maybe what figures she's producing, positive figures she's producing, can be possible with like an 80 million influx of funds or a 90 million. So she's, you know, painting an overly optimistic position. Now, by reading these 4 lines in this paragraph, what do you understand? Which ethics has been breached? Integrity, clearly, because they are lying. They are not honest. They are dishonest. So integrity has been breached. Then what else can you say? So I won't say professional due care is not applied. When can I say professional? Yeah, okay, I could say, because she's not acting to the standards, right? She's not acting to the standards of a professional, this thing. So we could say that. Yeah, the threat is intimidation. I agree. The threat is of an intimidation. But idea is, see, if you skip on what type of threat it is, it's fine. It's fine. But to skip on which ethics is breached is a problem. You need to talk about which ethics is breached. Okay. If you don't talk about that, that's a problem. So yes, intimidation threat, I agree. but you always need to connect with which, yeah. So yeah, you can say that it's of course a professional behavior which is being also breached, because you have to, when you talk about integrity, I think there's an always overlap with professional behavior, right? That if you're not being true, you're also not behaving professionally correct. Due care would also, I would say, when you're by mistake or because of lack of knowledge or because of something like that, you're missing on things. So I wouldn't say due care, but yes, professional behavior, yes. Okay. Now, Ms. Hayes is concerned that Byfloat will face a cash flow shortage within 12 months of the reporting date. Okay, so Byfloat is going to immediately face cash flow shortage, meaning even after borrowing a 50 million within 12 months itself, they still become again dependent for borrowings, right? So this is dependent on the club's future performance, its ability to renegotiate its OD facility, and the company's relationship with its key shareholders. The board has told Ms. Hayes that a going concern assessment is not required and that she is not to make no reference to any financial difficulties in Byfloat's financial statements. Now, if Ms. Hayes' assessment is that there'll be cash flow shortage within 12 months, and if her assessment is correct, then to not do a going concern assessment. Is this right or wrong? Of course, it's wrong, right? So, what is the issue that you see in this paragraph? What ethics could be compromised or breached? So again, if the board is pressurizing her and if she cares about her becoming from temporary to permanent, then it's her objectivity that's being breached. Yes, it's integrity. If she's going to end up not doing it, like not doing a assessment, then she's going to breach on the integrity. And of course, as a result, your professional behavior as well, right? Now it says most members of the Byfloat board include the FD and ex-professional football players. Miss Hayes has never played football professionally and believes that as a result, the board does not respect her opinion. So this is one more issue that she's facing, that she feels like her opinions are not valued. So this you can use for making recommendations, like what should she be doing, what action point she should take, like if this is the scenario. Okay, so we will write about the action points and discuss it while we're drafting the answer. We have, however, identified the ethical points already. Okay, so we'll start developing. So Ms. Hayes has been appointed on a temporary position, which is of 9 months, and become permanent later. As a result, she will always care a lot for, or she will always try to secure her position in the firm by not confronting members of the organization when asked to do wrong accounting. This leads to a breach, or this will hamper, I will say, this will hamper the objectivity of Miss Hayes, as she will always end up taking decisions to keep her job secure. Then what other issue we are facing? So the other is regarding the cash flow, the future projections, right? So we talk about that. Miss Hayes is to prepare a future cash flow projection in order to borrow funds from the bank so that they are able to bring their football team in a much better position with better facilities and good players. In order to get the 50 million for this from the bank, Miss Hayes will have to reduce cash flows, which will meet the requirement to receive these funds. We can see that Miss Hayes has produced optimistic cash flows in order to keep the board happy and be able to get the cash influx. However, Miss Hayes should have assessed the true cash flow projections position by keeping the realistic market factors in account. I'll write the action point as well right now here. Therefore, Miss Hayes should actually correct the cash flows by discussing this with her FD and explaining the importance of submitting more realistic cash flows before submitting it to the bank. Okay. Next. Okay, so there is also cash flow shortage, which she fears will take place and going concern could become an issue. But clearly the board has been telling her not to even bother to look into the going concern, right? So we'll talk about that. Miss Hayes believes that organization will get into cash crunch within 12 months or within, what is it exactly? Within 12 months of the reporting date, within 12 months of reporting date. This is an indicator of the going concern. However, the board has asked Miss Hayes to not check for going concern, as that is not a problem. However, Miss Hayes should conduct independent assessment free from bias whether it is a problem or not. Miss Hayes should, so what it can do as an action, because it's not being allowed, so Miss Hayes could consult the non-executive directors if finance directors and let's say other members are in, hand in glove. So Miss Hayes should talk to the non-executive directors in this case. She can also consult the internal audit committee for the same. If the organization is facing financial difficulties in real, then Ms. Hayes has to report this and cannot conceal it. Else she will be breaching integrity and professional behavior. Both. What can happen is if non-executive directors are not listening, if internal audit committee is not listening to it, then always as a suggestion on paper, you can say that she can consult ACCA body as well. Okay. So if she is, but really speaking, I don't see that, happening. It's not a practical solution, but yeah, on paper, you can fetch 1 mark easily. So if she is still facing difficulties in presenting the true and fair position, then she can also consult the ACCA body for the same. Okay. So I think in the above point where we wrote that she's doing the whole over optimistic thing and she should actually assess. So we did not write which ethic point is getting breached, right? So yeah. Miss Haas is proving so that they're in order, Miss Haas will be, you can see, so I'll just mention over here, this would be a breach. This would be breach of integrity and professional behavior. If she is still facing difficulty in presenting the true and fair position, then she can also consult the ACCA body for the same. Now, finally, like I said, it was written that she feels that her opinion is not valued. So you could have written just prior to, okay, she can consult ACCA, she can consult NEDs. Here I can add that point, or can make use of that point, okay? As Miss Hayes feels that her opinion is not valued, she should talk. In this case, she can also consult the internal audit committee for the same. If the organization is facing financial injury, then Ms. has to report this and cannot conceal it, else she will be breaching integrity and profession. If she's still facing difficulty in presenting the true and fair, she can also consult to the ACCA body for the same. Okay. So this is how you would go about in ethics. See, I won't say that if you write in point forms, you will not like achieve marks. You can write in point forms, still achieve marks. However, breaking it into small paragraphs and sticking in one paragraph around one theme is a little more appreciated version, but I wouldn't say points will not fetch marks. They can fetch marks. And if you would want to write subheadings, you can also write subheadings, like you can write integrity points under one, you can write objectivity points under one. But what happens is normally when you identify an issue, it so happens that there is an overlap, right? So it could be integrity and it could be professional behavior both. So you can write a subheading as integrity and professional behavior also. Then one heading could be objectivity. So you can do that. If you don't want, you cannot do that also. It's okay. It's okay. Fine. So ideally, guys, this is how you would have a strategy to crack your question 1 and question 2. The key takeaway from today's session, what should you take away? Like I said, in question 1, where the whole scenario of that pre-populated is posted or painted for you, you have to identify that you're always put in a shoes where you are in the position to correct it, not someone who's doing things from scratch. So you're doing things from scratch to identify what is the correction that is required. So always see what's wrongly done. Keep a very open eye and a brain to identify what's wrongly done. Then you can only suggest, okay, reverse it. Then have an eye and a brain open for what's been missed. And then suggest the differential. Like you remember In my first scenario, what can I say was missed? The non-controlling interest and goodwill was missed in the sense, okay, so maybe I'm not using the best term here. So one is something not completely done, so you do it. One something which wrongly been done, you reverse it. And one is something which is incomplete. So NC and goodwill were my incomplete figures. So you pass the differential impact. You pass the differential impact. So be careful of what element is recorded to what extent. Okay. Yes, you should read technical articles, but if you're my student, then I will say don't read technical articles which are highly number around the numbers, and for that you've already adopted one strategy, right? So let's take, for example, financial instruments. Now, if for financial instruments we have already adopted one strategy, I won't go and say, okay, get into the calculation strategies again as per the technical article, because that's a double effort. That's a double effort. But then there are always fresh articles which are highly discursive in nature. That I'll always recommend to read. Let's say, for example, something around your sustainability reporting, right? So those are fresh standards introduced, right? Your S1 and S2. So read around that. Your IFRS 18 presentation of financial statements. You understood the technique maybe from my lecture. The final lecture was on the technique that what is to be segregated, how is to be segregated. But there'll be a discursive element as well. And because it's a fresh topic, read IFRS 18. Okay. Read IFRS 18. Read sustainability related technical articles. Any other technical article which is on discursive element, read it. But any article which is on the number crunching part, that this is how you calculate and this is how you calculate, I would say it's a double effort. Avoid it, because you wouldn't want two versions of the same thing. You wouldn't want two versions of the same thing.
Hello, Miss.
Yes, Omi.
I have something to say. I'm having issues with question 4.
Sorry.
Like the invest, I said I'm having issues with question 4, like the investor focus questions, and like when they say talk about disclosures, like I don't be knowing what to write. I find it hard.
The question 4 style investment focus, you're finding it a little hard.
Yeah, I didn't even know there was question 4. This is my problem. But I didn't know there was question 4 till like 2 days ago. So I'm having like problem answering those questions.
Okay, no problem. So tomorrow, any which ways, we're doing question number 3 and 4. So anyway, that style will come, the investor focus style. Also, what I can do is then maybe segregate all the investor focus questions that we have on the portal for you all, and then give the list of that, right? If more practice is required around that, then anyway, you're going to have something called pre-mock. I'm going to share a schedule. So you're going to have a pre-mock where you all are going to crack 2 questions independently yourself, and I am going to just give a debrief on that. This is not your regular mock. Your regular mock is something else which you will crack. Debrief will happen. I will do the correction. This is not that. This is all there. Other than that, there is a pre-mock that's being introduced from this quarter, where 2 questions, 50-mark paper, you will crack from yourself, from your side, and you will submit it. A debrief will take place, and in that debrief, you can correct it for yourself. So I'll try to keep these areas like investor focus and those questions there. Of course, so what is happening is tomorrow, and one investor focus gets discussed in your full length mock, one investor focus gets discussed. Pre mock, I could end up, adding a pre investor focus. So 3 to 4 more questions you can expect getting added there. Okay. So Vicentine, okay. So ideally, so are you my student or are you not my student? I would want to know this, because if that's the case, then you can attend lecture 6, like if you're my student. Vicentine, are you my student or not? You're just
Hello,
come for the
ma'am.
webinar.
I'm not included in a current batch. I'm new.
Okay. Okay, no problem. Fine. Michelle, like I said, the answer I'll tell the team to put it in the YouTube link somewhere so that everyone has access for the same. Yeah. So the change that's come about, the important change that's come about is IFRS 18, right? IFRS 18 is a new way of presenting your profit and loss statement mainly, right? And what happens is earlier you did not have mandatory subtotals, right? You had gross profit, you had your operating before interest and tax, you had your profit before tax and all of those figures. What IFRS 18 said that, you know what, 3 subtotals are mandatory. Okay. What are that? Gross profit is not a mandatory subtotal. You might think, okay, you know what, gross profit is a mandatory because in every sum we do it, but it's not mandatory. Let's say gross profit is a missed figure. Can I say, is it in compliance with IFRS 18? Yes, it will be in compliance with IFRS 18. What is then my mandatory subtotal? So your mandatory subtotals is profit before financing and taxes, right? So that is one of the important or mandatory subtotals for you. Okay. Then you have your operating profit. That is one mandatory. So even before profit before financing and taxes, you have operating profit. Okay. So that's mandatory. Then profit before financing and taxes, that's mandatory. And then profit for the year, the final profit, that's mandatory. These are all mandatory subtotals. Second, the other important change, your P&L is divided into sections. Maybe we don't write in the P&L anyway that, oh, this is my operating section, this is my investing, and this is my financing. But IFRS 18 has called out sections that anything that's starting from your revenue line till operating profit is your operating section. All the hardcore business activities, okay? Not sidey incomes, not sidey expenses, all that's gone into your hardcore business activity. Then after that, your investing income starts, right? So, investment income from investment in shares or bonds or rental income. So all investing activities will go there. Change in the fair value of the shares, change in the fair value of the investment property, depreciation of the investment property, all of that sits there. Okay. And then you have your financing activities where you have your interest income. So when you when your discursive element, when you discuss things, you can no more say this goes to your P&L. You have to be very precise, whether it's going to operating, whether it's going to investing, whether it's going to financing. Then after that, you're recording tax. So tax is also a fourth section identified that it's a taxation section. And finally, profit from continued and discontinued operations. So profit from discontinued operations is also one section that is recognized. So you have to pinpoint where it's gone. So this is the change that has come, that when you're talking, when you're describing your answers, that this is the impact goes to P&L balance sheet, be precise where it's going. Okay. And the format, the mandatory three subtotals, identify them and identify that, okay, this P&L, even if gross profit is missing, is a is a IFRS 18 compliant P&L, not necessarily not compliant.
Miss, can I say something about IFRS 18?
IFRS 15 or 18?
No, 18.
Yeah.
So yesterday I was trying to read it, and then I saw something called MPM. I don't know. It says management performance measures. So I don't know if that's
Yeah.
Can you
Go
talk
ahead.
about that maybe tomorrow, or because I'm not sure I understood it, because it kind of looked like the, I think, APM that we already did from the lectures in
Correct.
class. So I don't know what the difference was.
Correct. So there is a very small, tiny, mini element also in IFRS 18 MPM. That's right. And that's right. That's something I'm going to discuss tomorrow. So tomorrow, what all elements I'll tell you, other than question number 3 and 4, I'm going to touch base upon modification and revenue, because question number 3 and 4 are not going to be as lengthy as what we have done today, meaning like the whole consolidation question, right? So I'm going to touch base upon modification and revenue. Modification of leases is something I've not touched in the pre-recordings, right? So tomorrow I'm going to touch upon it, because there is an element in my section B in it. So I will touch base upon that. So you'll have enough clarity, complete clarity rather, I would say, not enough, that what to do when there is a modification of a lease, how to do the numerical element, how to do the written element, and MPM. After that, we move to question number 3 and 4. And guys, I would want you all to hold right now, because I want to showcase the plan. Okay, I want to showcase the plan, upcoming plan. So you already here where you have completed the 9th August day 1 webinar. Then you are going to go tomorrow to 10th August, which is a day 2 webinar. Then you're going to have a practice session on 12th August. Okay. So this is a practice session which is going to be there for the crash course students. One extra practice session introduced where our regular students, you all can come and also sit, right? The regular paid students can come and sit. This is not going to be a free thing, guys. This practice session of 12th August is not free. Then you have a pre-mock practice session where you will independently solve. Invigilators will be there. Google link will be shared. I will not be there, but invigilators will be there. Then I will give a debrief on this pre-mock. Okay, I'll give a debrief so that you all can check it for yourself. Then there'll be an extensive grand revision, which is a revision of all the standards. You have your final mock on 22nd August. And on 24th, I give a debrief. You will not have your corrected scripts by 24th, because checking a script of SBR is a very lengthy process. It's a very lengthy process. Each script is going to take for me good enough time, like more than 1 hour. Easily, I can say more than 1 hour. Okay. Each script could take that much time. And the results. So basically, I'm going to finish correcting scripts by 29th. So I'll declare the results by 29th. There is a complimentary mock. So that's not something that's going to get corrected though, but it's going to be given to you all along with a recorded debrief session, along with the recorded debrief sessions. So timings, mostly the teams are going to update with the timings 24 hours prior to the session. So you all can take a screenshot of the timetable that this is how it is going to be. All this crash course material that's been designed, the practice session, the pre-mocks and all of this, the regular students will always get to be a part of it. Okay, so these are like, I would say two regular sessions, getting added. So you already had 6 sessions, 2 more sessions you can say is getting added because of this whole timetable. Okay. Okay. Thank you, everyone. See you all tomorrow. Have a good day. Bye-bye.
Bye. Thank you.
Bye. Thank you.
Thank you. Bye.
Thank you, everyone. Thank you. Bye-bye.